Now, step two is we want to then, look at the past performance. We want to really evaluate that. We want to see what the volatility has done previously to a stock as it moves closer into its earnings release and even after. So we want to see if we can spot some kind of opportunities that tend to kind of consistently come up with a specific stock. So that's a really important step. And then this will get us more prepared to look at the dramatic increases in stock volatility. Now, typically a stock, normally if you look at implied volatility ranges, stocks are typically, 25 to 40% implied volatility, excluding some of the, the really high, beta type stocks, but typically 25 to 40% implied volatility. But the week of the earnings release, this volatility can easily move to extremes of 2 to 3 times what's normal. And that's what we can, get prepared to trade. Now, this is what makes a stock potentially great profit opportunity. So volatility a lot of times will normally double, and in some cases it will be even more extreme than that. And that's what we want to look for, and that's going to present us the different various opportunities for trading a specific stock as it goes into its earnings. Now, here's just an example of how extreme volatility can get. This was NVIDIA, and this, you can see where it was trading. This was back in its younger days. It was traded here at $270. So the earnings were going to be released on the 13th. So this was going to be a Thursday, and then one day later was expiration. So this is kind of typical of a lot of these types of stocks. So you can see this one day to expiration, the implied volatility here was jacked up to over 114% implied volatility. Now, normally, you can see here NVIDIA, these are the other series behind it. You can see normally it's 45, 40, etc. But in this case, it popped up to 114%. So you can see that huge spike in the implied volatility, over 3 times kind of the normal implied volatility. And this number here is the expected move for that one day. So it's saying it theoretically it could go up $17 or it could go down $17. So that's just one standard deviation. So you can see the potential, the extremes of this. So, if you look at a normal distribution curve, and you can see that NVIDIA, say, is trading at 271, the implied volatility for a normal move is that it could go up here plus $17 to the upside, or it could go down $17 to the downside just in this one day period. So that's a huge move, and that's one standard deviation. And a lot of times we're going to see potentially that these movements could be 2 standard deviations or even more up or down. So this is what we want to be prepared for, and to understand how to take advantage of this and the different strategies to use for trading this kind of jacked up implied volatility. So here you can see the day after its earnings release. You can see where it's what we call a volatility crush, and the price is also spiked up 7.5%. Now it's at 291, but look at the implied volatility. It crushed, it completely collapsed down, and now it's back down to its normal range. So, the day before it was going at 114%. Now it had crushed and was down back to kind of the norm. So that's a couple things that we can look to take advantage of, that high spike in implied volatility. And so when you're, selling options and option strategies that sell options, we're basically selling volatility and selling time. So that's one way that we can take advantage of that high implied volatility.